Hey, Renter Retires, it's Adam Schroeder here with another episode, and I am joined today by Brian Davis. He is the co-founder of Spark Rental. Brian, thanks so much for joining us today.
Adam, thank you so much for having me. This will be fun.
Oh, man, you're bringing way more energy than me. I'm going to have to up my game.
It's Friday. How can you not be excited when it's Friday, right?
Yeah. So, Dels, we always start back at the beginning. So tell us a little bit about kind of your very first real estate deal. How did you get into it?
Oh, man, I fell into real estate, like so many people. I graduated college back in 2003, had no idea what I wanted to do with my life, fell into working for a hard money lender and, did a summer internship working for them. And, when they invited me to stay on at the end of the summer, I was like, yeah, sure, why not? I like to real enough. And so this is back in the mid-aughts, and I'm working with all of these house flippers and burr investors, and everybody's making money hand over fist. And, of course, I walk away with the message of, like, I can do this too, right? I
can make money never goes down.
Right, yeah, exactly. Yeah, an elevator that only goes up. So, I plowed all of my, every spare dollar into real estate, bought a bunch of rental properties, way overpaid, didn't know what I was doing. And then, totally just face planted in 2008. And among many other expensive lessons from that era, one of the things that I discovered is that I just hated being a landlord. I didn't like tenants showing up at my door at 9:00 at night. I told this story about how the woman who's currently my wife, when we were on our fourth date, I invited her over to make her dinner, and we were watching a movie on the couch. And, they're 9:00 at night. They're boom, 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 boom. And there's a tenant at my front door, with his interpreter because he didn't speak English, try to talk about the property and catch up on back rent. And I hated all that stuff. I hated tenants calling me when I was on vacation and, ruining my weekends and all that. But there's a lot to love about real estate investments as well. All those things that I liked when I first was watching people invest in real estate back in the mid and late aughts, that's still all true, right? I mean, the ongoing income, the appreciation, the tax benefits, the hedge against inflation, the diversification from the stock market, use of leverage, leveraging other people's money or other people's time. Like, these are all great advantages to real estate. And I learned that you can have all of those advantages without becoming a landlord, or without swinging a hammer or flipping houses. So, there are endless ways to invest passively in real estate, and that's what I do today.
Sounds like you could have benefited a lot from the use of a property manager back in the day, and not had your dates interrupted.
I had property managers. They just weren't very good. And, one of those expensive lessons that I alluded to a moment ago. So when I first got into real estate investing, I was buying in bad neighborhoods, to put it politely. And I learned that good property managers don't work in bad areas. They don't take on bad properties because they don't have to, right? They get paid as a percentage of the rent, both in the form of the rent that they collect for you and also, 1 month's rent or half a month's rent or whatever they charge to fill vacancies. So the higher the rent, the more they get paid. So the better property managers only work with higher end rental properties. And so as someone who owned a bunch of lower end rental units, trying to find a good property manager was just nearly impossible. Because I was left with the dregs of the industry. So anyway, I don't mean to, go down a rabbit hole with that, but that was one of those many expensive lessons that I learned as a landlord.
Well, let's dive into that part a little bit more. And how long did it take you to realize that you would probably be better served leaving the lower tier priced real estate and not worrying about, because so many people, they'll see a pro forma and they're like, oh my God, year one, look at this. It's 20% cash on cash and I'm absolutely crushing it. And they don't think about the fact that there's going to be CapEx down the road or expenses down the road, or, your vacancy or not vacancy, your maintenance percentage is going to be higher because a, $100 repair on a $600 rent hurts a lot more than a $100 repair on a $2,500 rent. When did you learn that lesson, and kind of what was the sticking point that showed you that maybe this way isn't the way?
Well, I have to confess, I was a slow learner with that stuff. Now that being said, I went on a buying spree in the from like 2005 to 2008, and that was when I bought most of my direct ownership properties. And I ended up getting rid of those properties in the late teens after moving overseas, which is another story. But yeah, so I didn't buy a ton of new properties after 2008 and the crash and some of those expensive lessons. But, to your point, about those lower end properties, they come with a lot of hidden costs that don't show up on paper. And I didn't realize that when I was a young, dumb real estate investor in my 20s. You mentioned, how the returns on these lower end properties can look really good on paper. Those performers can, they pencil out beautifully. What you don't see is that those high crime rates in those areas, not only do they cost you money directly in the form of, vandalism and, theft, people break into your units, stealing your appliances. I can't tell you how many air conditioning condensers I've had ripped apart, by people in these bad neighborhoods just to pull out the copper piping in them. I ended up having to install these big steel cages over the air conditioning units. And then people still found a way to get into them. I couldn't figure it out. Like, how are they getting in? I mean, are they using like diamond edge chainsaws? Like, anyway, so there's the direct cost of that stuff, but there's also the indirect costs where a lot of my good tenants in these properties, they would leave because of the high crime rates. So, you end up with the higher turnover rates because your good tenants don't want to stick around in these bad neighborhoods. And, it just gets worse from there. We already talked about how good property managers don't work in these neighborhoods. It's a mess. And, the credit scores tend to be very low in these neighborhoods. And, even the good renters often have bad credit. So it gets really hard to screen tenants accurately in these neighborhoods when, everyone looks pretty bad on paper in these neighborhoods. So there's just a million reasons why these properties just never perform as well on paper or perform as well in real life as they look on paper.
Yeah. So you bought a bunch of property, leading up, I'm assuming based on the time you probably put zero down or very, very minimal amount of money down on these properties. And then you survived somehow through the Great Recession. You came out on it. And then you saw 2020, 2021 happen. Did you start getting like flashbacks during this time, or were you, because there were a lot of people who were worried, they're saying real estate's going up, it's going to be just like the Great Recession. And kind of what were your thoughts as that was happening?
Yeah. So, a couple of things there. So I got into passive real estate investing in the late teens. I got rid of all my rental properties, started putting my money into things like real estate syndications, private partnerships, private notes, debt funds, real estate crowdfunding platforms, all that kind of stuff. And then, it was a little reminiscent, in 2022 when interest rates shot through the roof. And before that, in 2020 and 2021, and the first half of 2022, there was some frothiness in the market that, you were just kind of alluding to. So it was a little reminiscent of 2008. It was not nearly as devastating for me, and I'll tell you why. For one thing, in 2000 or leading up to 2008, I had put a bunch of I owned all those properties totally by myself. I had my own money tied up in them. I had loans that I had signed a personal guarantee on for those. With passive investments, first of all, you can invest relatively small amounts, and that's actually what we do as an investment club. We go in on these together to keep the amounts small, or at least to create that option if people want it. So that reduces your exposure to any one property, which is nice. You also aren't liable for the loans on these. You don't sign a personal guarantee. You can't be sued. Whereas I was sued several times as a landlord, and named personally in those suits, despite owning those properties under an LLC name. So, it was not nearly as painful for me over the last couple of years as it was in 2008. So, and I'll put that in perspective with some real numbers. In our co-investing club, our passive real estate investment club, we've done over 24 deals together. We get together every month and we vet these together. We've been investing since 2022, really. So we entered at really a bad time in the market. If you look at it in those terms of like time in the market, which I try not to, by the way. But if you, from a timing perspective, we did everything wrong from that perspective. Only one of those deals has completely imploded. There's another one that had to be bailed out or is in the process of being bailed out, but I'm cautiously optimistic it will be fine. The other 24 deals or so are actually performing fine. I mean, we're receiving our distributions on them. The business plan is moving forward. And it's not like I can claim credit for being some kind of oracle with these. It's just due diligence on them. I've obviously gotten a lot better at due diligence over the last few decades being in this industry. But it also helps that we are vetting these as a community. So, we've got 20, 30, 40 sets of eyeballs all trying to poke holes in these deals from different angles. So it just, that's a lot easier to vet investments when you're doing it with a bunch of other seasoned investors, who are all coming from different backgrounds, different experience levels, different geographical markets. So, it's just a lot easier when you can spread small amounts of money across a lot of different projects and vet those projects with a lot of other people.
Yeah, let's dive into that due diligence education that you've been put through. You mentioned like high crime areas and how that translates differently. So now I'm assuming you're not investing in high crime areas. So whenever you're going in and looking at an area, what metrics are you looking at, and where are you finding and pulling this data from?
Yeah, so it's worth mentioning, by the way, that I'm not a sponsor myself. I'm not a GP. I'm not syndicating deals. We simply administer an investment club with a flat fee model. We don't get any of the money that we are investing, and it's not like we get a cut of any of that. So I'm not a GP. I'm not going out there and like trying to underwrite deals myself.
But you're vetting them for your personal investing.
Yeah. I'm done with all that. I no longer want to do it, especially as an expat living overseas. So, but we still look at crime in these areas. So we try to avoid Class C areas and certainly Class D areas, and we try to invest in Class B or higher areas. Now that said, we'll we still like some of those deals where you're buying a Class C property in a Class B plus area. That's fine, right? That's
the point of value add, right?
Yeah, that's the value add. But we don't normally invest in C areas. If we do, there has to be some kind of mitigating factor involved. So yeah, I don't like crime. My rental properties were all in Baltimore City in like the worst neighborhoods in the country. I'm done with all that. I don't want to do that anymore. We actually we do invest in multifamily syndications. That is part of what we do. We also like to diversify well beyond multifamily as well. So we do different property types, whether that's industrial, mobile home parks. And I know I just said, it sounds like I'm contradicting myself there, with Class C and mobile home parks. But I do like mobile home parks a lot, actually. And we can talk about that separately if you want. But diversification into other types of property, industrial, retail, mobile home parks, storage. We like all of that for many reasons. One is that there's lower regulatory risk, but also simply diversification. I don't know what will be the next hot property sector, but if I have my money in all of those different asset classes, I don't have to have a crystal ball. So, some of them are going to perform well, regardless of what tomorrow's market brings and tomorrow's policies bring. We also are all about geographic diversification as well. So we have investments all over the country. We would like to add some overseas as well, but that's just a lot harder to find reputable people who are doing it, to underwrite those deals, to manage risk. But yeah, we're big on diversification across the board and diversification among sponsors as well. That's really important to us. And beyond that, we also like to do more than just syndications. We like to do private partnerships. So for example, this month's investment that we're looking at as a club, it's a private partnership with a house flipping firm based in Michigan, and they do 60 to 90 flips a year. So we're going to be partnering with them on a series of flips and just rolling the proceeds of one flip into another and do a series of these through the end of next year and then close it out by the end of next year. But that comes with a totally different set of risks and rewards than, say, a multifamily syndication. So we love doing all of these different types of things, and we believe that reduces our risk quite a bit.
So are there any particular parts of the country? I mean, we invest a lot in the Midwest, the Southeast, because we find those are the really good areas. But are there any specific markets that y'all really like in terms of kind of like the up and coming, or where you're seeing just really good deals now? I know you mentioned the fix and flips in Michigan, but surely Michigan isn't the only place that y'all are looking at geographically. So kind of what areas are you seeing as potentially really good for finding investment, or finding groups doing investing there?
Yeah, so no, I mean, I don't have anything particularly in favor of Michigan. It just happens to be where this partner, who we've worked with before and really like, it's where he happens to operate. So that's why we're doing it there. But no, there's nothing particularly spectacular about Michigan as an investing market. In some ways, quite the opposite. But it's more about him as a partner than it is about the market. Yeah, I mean, we're pretty agnostic geographically. It's not like there's one market or a couple markets that we're like really gung ho about and like pounding all of our money into. Quite the opposite. We like to spread it out geographically. I will say that we try to avoid markets that are extremely tenant friendly with their regulations. We prefer investing in more investor friendly markets. That being said, it's not that we will never invest in those markets. There just has to be some mitigating factor. So, for example, we did a deal in Southern California not long ago, and Southern California obviously very, very tenant friendly in its regulations. But this was a property that was it's a vacation rental property. It's got 11 cabins on it up in the mountains, about an hour and a half outside of both San Diego and LA. It's an unincorporated township. There's no risk of them outlawing Airbnb, for example, right? You don't have to worry about landlord-tenant regulations because people are just booking these for a weekend, for a week at a time, corporate retreats, that kind of stuff. So those landlord-tenant regulations don't apply to this particular investment. We did do a multifamily syndication outside of Portland, Oregon, also very tenant-friendly regulations. But the mitigating factor there was that this syndicator actually started as a property management company back in the early aughts. So their expertise and their background is specifically in residential property management in this exact market. They've done a ton of syndications right there in the Portland metro area. So they know those regulations inside and out. They have much more expertise than the average syndicator operating around there. So we agreed to do that deal based on that company's expertise in that market. So yeah, I mean, we have a map on our website showing all the places around the country where we've invested, and it's the reason we show that map is that it's there are pins all over the country. So yeah, we're pretty agnostic about geography. We want to spread it out so that we're not all concentrated in this one market that everyone thinks is really hot right now, but is going to be the one that collapses tomorrow.
So where are some of the areas that are, landlord friendly that y'all have seen some of your best returns come in? Is there a specific, could you name like your maybe 2 or 3 markets that kind of jump to mind that you've seen some really good returns whenever it's all said and done?
Well, let's see. We've done a disproportionate number of deals in Texas, which is pretty investor friendly. That being said, Texas, that lack of regulation in Texas cuts both ways because there is much less red tape for building new multifamily properties in Texas. So, there's been a lot of new construction there, a lot of new rental units coming on the market. So absorption has been an area of concern in a lot of those Texas cities over the last year or so. So, rents have been pretty flat in Texas over the last year or so. They're projected to remain flat for the next year in a lot of these cities in Texas, Houston, Dallas, Fort Worth. So, those deals have all performed fine for us. They're all performing as projected, or at least most of them are. We're getting distributions on them. The sponsors going through their value add renovations. So, yeah, I mean, we're probably, we're not looking to do any more deals in those markets because we're probably a little overexposed there. And like I said, we do want to diversify as much as possible geographically. But that's been fine. We invested in a cluster of properties in Kansas City, and they've performed well. It was a portfolio deal of 2 multifamily properties and a retail center that's actually attached to one of those properties. But yeah, I mean, we've invested in a lot of Midwestern cities that have pretty stable cash flow. There's not a lot of new construction going on in a lot of those cities, so there's not a big threat from new supply. I mean, we're pretty agnostic about geography.
Yeah. Okay. So what are you, as you look at the real estate, spectrum right now, and you hear about all the talk about what people think is going to happen over the next year. And as somebody who was just in Houston last weekend, I can say from everything I've seen, I don't see rents there staying flat because there is so much going on in that city that it's astounding. But what are you thinking we might be seeing in the real estate market over the next year? Let's say, kind of, what if you had a crystal ball and you were looking into it and telling me my fortune, what would you say the real estate world is like in a year?
Oh man. All right. So 2 answers to that question. One is that I try never to look into the crystal ball because every time I've tried to predict the future, try to get clever, try to get cute with my investments, the universe has just slapped me upside the head. And that's why we try to practice dollar cost averaging with our investment club, doing $5,000 at a time every month in real estate investments, so that we don't have to predict the market. But that's not really a satisfying answer to your question. So I will break my rule and I will look into the crystal ball. So I think for the last year, a lot of people in the commercial real estate industry have been just assuming that interest rates would go down, and they would go down quickly, and everything is going to just go back to the way it was in 2021, and we'll all just skip off into the sunset and sing Kumbaya. And that has not played out, of course. There's sentiment now that we will probably get at least 1 rate cut before the end of this year. But it's as recently as 6 months ago, people were saying, oh, there's going to be 3 rate cuts in 2024, and everyone was kind of, or not everyone, but a lot of people were penciling deals with these assumptions that rate cuts were just going to come right back down to where they had been. I think there's a risk that rates stay higher for longer and that they come down more slowly than people were expecting. So that's a risk that I think everyone should just keep in mind as a possibility and not assume that rates are going to crash back down quickly. I certainly do not want to get political, but I see different risks for real estate investors under each of the 2 presidential candidates. There's risks that come with both of their proposed policies. And I think, investors should just keep those different risks in mind, moving forward, into the coming few years. I see, well, yeah, anyway, like I said, I won't go into politics, but, rents, one thing that's been interesting about the last couple of years is that rents almost never go down historically. Even during the Great Recession, rents just kind of flatlined for a couple of years. Rents have declined in some markets around the U.S. over the last 18 months or so, and that's very unusual. That almost never happens. So that's a quirk of this current market that we're in. Some of that is based on a lot of supply hitting the market all at once. Everyone got really construction happy back in 2021, 2022, and those deals take a long time to come together. So we've been trying to not pull out of multifamily, but just pull back a little bit on the number of multifamily syndication investments that we do in our club and that we look at. We've been trying to do more alternative types of passive investments, like private partnerships, like that flip partnership that I've described a minute ago, but also different property types, private notes, all of these different types of investments beyond just kind of the bread and butter multifamily syndications. I do think that it's a much better time to invest in multifamily syndications now than it was 2 years ago. And there's going to be increasing opportunity in multifamily syndications as a lot of these bridge loans come due, as foreclosure rates, keep ticking upward. But, we're still trying to do a lot of different other types of passive investments, not just multifamily syndications.
Yeah, I think we're also seeing some softening in rents because, at least around here, I'm in Austin, and around here, rents went up 25% in a year and wages didn't go up 25%. So we're kind of coming back down to, hey, maybe not a, 25% increase is feasible for people long term, but, you did get it for 1 year. But I want to go back to my kind of final question here before I have you wrap up and tell everybody about who's going to fit with Spark Rental. Is you mentioned kind of when you went to Portland, you changed and kind of opened up your criteria a little bit because of the operator, and how Detroit isn't, or not Detroit necessarily, but Michigan isn't necessarily the most landlord friendly, but y'all made a kind of exception because of the operator you're working with. So what is it that allows you to determine, yes, these are our criteria, but because of this thing, I'm going to allow it? Because that can be dangerous in some situations. So what do you need to see to be willing to change the criteria y'all have come to an agreement kind of as a group that you're going to invest in?
Yeah. So there's a couple points there that are important to make. So one, just to clarify, the investment that we have just been looking at this month is a flip partnership with a house flipper. So there's no landlord-tenant regulations don't apply there.
Yeah.
He's just going in and flipping houses, and we're partnered with him on some of those flips. So the regulation does not affect that particular investment. As for looking at risk, one of the things that we look at is debt. Of course, what's the LTV? What's the term on the debt? The longer runway you have with the debt, the more time you have for a better market for selling or refinancing to come along. The sort of nightmare case study that we often give as an example, that one deal that totally imploded that I mentioned earlier, it was a classic case of the sponsor taking out short-term bridge debt with a variable interest rate, with no rate cap or rate swap, or no protection in place for rising rates. So of course the loan payments went through the roof, and and the property went cash flow negative. But the shorter the loan term, the sponsor can run out of time, in addition to running out of money. So we teach a class actually on analyzing risk, and at the very beginning of the class, we say that the two ways that syndication deals fall apart, and that real estate deals fall apart, is either the lead investor runs out of time or they run out of money. So you want to look at all of the common reasons why those two things happen and try to eliminate all of them, right? Or at least look at those risk points to analyze what is the risk of any of these things happening. And a couple of those risk points that we look at, one is property management. Deals that go bad typically go bad. Bad property management is usually one of the things that goes wrong in those deals. I've seen struggling deals be salvaged by really excellent property management, even though the sponsor made a lot of other mistakes. For example, taking out the short-term bridge loans with no protections for rising rates. And I've seen otherwise good deals fall apart because of bad property management. There's a deal that we saw where the occupancy of this property is at 46% because the management's been so bad. So
that's impressive.
Yeah. How do you even let the occupancy get that low? I've never seen that happen. Anyway, so we look at how many properties has the lead investor and the property manager worked on before. So it doesn't matter whether they're in-house or whether they're outsourced. What matters is their history working together. A team that's been working together for 15 years on a dozen different properties, 24 properties, that's low risk. A team where they've never worked together before, that's really high risk. Same thing with construction and renovation teams. It doesn't matter if it's in-house or if it's outsourced. What matters is how much experience do they have working together. So same concept there. we also look at the underwriting of the deal. How conservative is it versus how aggressive? Are they with their pro forma projections? Are they using pretty conservative numbers for projected rent increases, or are they using really unrealistic numbers for those? Likewise, are they using really unrealistically low projection numbers for expense growth, or are they trying to overestimate how quickly expenses will grow? Because that's something else we've seen over the last few years is much higher labor costs and much higher insurance premium costs in particular. Those two sets of expenses have really risen much faster than rents over the last 2 years. So we want to look at how conservative are the projections here. We look at their sensitivity analysis. What are they expecting for an exit cap rate? Is it a relatively high exit cap rate as a more conservative number, or are they just assuming that that cap rates are going to compress, or even that they'll get the same cap rate that they bought it for? We want to see a pretty conservative sensitivity analysis, looking at both exit cap rates and rent growth. So these are a couple of the things that we look at, but the most important thing is just the sponsor or the partner themselves. How much do you trust them? What's their experience level? Have they invested through multiple market cycles? To come full circle here, I like to see people who, lost some money in 2008, or, who were in the game in 2008, rather than, they got in like 2019 and, all they know is, this really easy bull market from like the mid to late teens up through 2021, 2022. If that's all they know, then yeah, they're not going to be as conservative as I want them to be. But yeah, track record and reputation they're important, but they're not everything as well. The two worst deals that I have seen came from sponsors who were like the golden boys of the commercial real estate industry a couple of years ago. They had huge brand names. They were very well respected. Everyone just gushed about how wonderful they were. And then they've totally collapsed and imploded over the last 18 months, 2 years. So reputation does matter, and you do want to double check that. Track record does matter, but it's not everything, and you really have to dig beyond that and really get a sense for how much experience does this person have in this property type, in this geographical market, and how long have they been doing this? How many market cycles have they been through? So it's a long-winded answer to your question, but hopefully I touched on some useful points.
Yep, absolutely. I really appreciate it. And I want to wrap it up here by just giving you an open forum to tell people about Spark Rental and how they can get in touch with you and who's even a good fit for your group.
Yeah, so we operate a classic investment club model. We get together every single month. We vet different passive real estate investments. Anyone who wants to participate in those investments can do so with $5,000 or more. And then collectively, we'll be investing $150,000 to $300,000 or so. So, we surpass those high minimum investments that you have for a lot of these passive real estate investments. But each person only has to invest a relatively small amount. And not has to. No one has to invest anything in the club. Everything's purely optional. So we are really serving, working professionals who are busy. They don't necessarily want to become landlords, but they do want to diversify into real estate. And this is a way for them to, hopefully earn those asymmetric returns, to collectively vet these deals and find those deals that offer relatively high returns with relatively low risk is what we're aiming to do, without any of the headaches or burdens or risks of becoming a landlord, such as being sued or, signing as a personal guarantee on the loan or having your nights and weekends ruined by tenants, etc.
All right. Well, the website is sparkrental.com. It'll be in the show notes. That is sparkrental.com. I really appreciate you joining us today to talk about your history and what's going on in the real estate market. Glad you were able to dust off that crystal ball a little bit to give us a little take there. Now, if y'all want to check out the properties that we have them over at renttoretirement.com. That's renttoretirement.com. Schedule time to talk with us. Check out our properties. And also don't forget, if you have any questions, please email them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. And Zach and I will cover them in future episodes. Really appreciate the time y'all spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.